Hi, and welcome to the Stockscores Market Minutes for September 14th, 2015. This week, I want to teach you a little bit about what these lines that we draw on stock charts actually mean. We can classify them into a number of different types of lines. We have those that are drawn across rising bottoms or falling tops. We can notice whether lines are converging toward one another or diverging, in other words, moving away from one another. And then we've got the horizontal lines that we tend to draw at highs and lows. And of course, what's critical with all of these is whether we break through these lines. So as I go through the charts this week and the analysis for this week, I'm going to describe why is it a rising bottom and what does that actually mean. If there's lines converging or diverging from one another, I'll explain what that means and so on. So let's look at the charts. Here is our first chart, the chart of the S&P 500 ETF. This is a 60-minute chart going back 3 days. You'll notice I've got a red line drawn across rising bottoms. A line that is moving up from left to right means there is optimism over that time period. Essentially, at any time the sellers are pushing price down, they are unable to push it down as low as they had the last time they were pushing price down. And that's a sign that the sellers are losing their strength. So when you have rising bottoms on a chart, you have strength or buyer optimism building. We've also got a horizontal green line right here, and that is drawn at an inflection point high. And that's really the upper limit of what people are willing to pay for the fundamentals. So historically, and this is a very short history, this is only 1 month, and that green line only goes back a week or two, well, a couple weeks. What that essentially means, though, is that in the last 2 weeks, no one has been willing to pay more than $200 for the S&P 500 ETF, which is just about $2,000 on the actual index. And that is the upper limit of what investors are willing to pay for the fundamentals. All right, so this chart is slowly building optimism, given that the trend into the chart, if I was to draw a line across these tops, that would be sloping down from left to right, and that would mean that there's pessimism there. So we have pessimism into the pattern, and now we're trying to build optimism, which is trying to build a base, but we still need to break through this critical line of resistance to show that investors have found a reason to pay more for the market. All right, here's the long-term chart of the S&P 500. I have drawn a long-term green line across the bottoms. That is a sign that there was optimism in the market. That optimism was broken 4 weeks ago when that upward trend line, that line of optimism, was shattered by the sellers who are willing to push stocks down below that upward trend line. That means that the confidence in the bull market has been broken. Now, the only way that it can resume is if we move to new highs. So if we rally from here and move up to new highs, then the uptrend remains. For now, however, this is a bearish signal because the upward trend line has been broken. The buyers have lost the control of the market. All right, here's the chart of the Russell 2000 Index Fund. And what I've tried to show here is that we have rising bottoms. I've got a low here, which is lower than the current low. Now this low hasn't really been established yet. It's the current low, but we could certainly move to new lows from here. We're still down below this red downward trend line. That fact that it's going down from left to right means there's pessimism over the last 2 months, 2.5 months. And until that is broken, the pessimism exists in the short term. Long term, we still have optimism here. I could draw a line across these bottoms and it would be sloping up from left to right. And that would mean in the very long term, there's still optimism. But in the last 2.5 months, we have pessimism in the U.S. small caps. Here's the 60-minute, 30-day chart of the TSX. You can see that we've got some pessimism building here because there's falling tops. Each time the buyers tried to push this market higher, they couldn't go back to the older highs. Again, this is a very short-term view, only in the last 2 weeks. But it's different than the U.S. market where we had rising bottoms over that same time period. So in the last 2 weeks, the Canadian market has been underperforming the U.S. in terms of the mood of the market. And also we have pessimism going into this pattern. In fact, I could draw a line across these tops and you would see that it just basically touches all those price peaks, which shows that the sellers are in control of the market. Now we are at some support. This is that horizontal line, the lower boundary of what investors think the market is worth, what the fundamentals are worth. And you can see we've bounced off of that a number of times, and we'll see if we bounce off of it again. But given that there's pessimism building, I do think that we could see lower prices here. A lot of this will depend on what happens in the oil market. Now, longer term on the Canadian market, we've really had a dead market for well over a year. Market that's been going sideways. I mean, in the last 6 months, it's been selling off with the weakness in oil in particular, taking that market lower. But what's interesting is that it really doesn't have the same amount of downside as the U.S. stock market. It's already suffered. It never really kept pace with the U.S. market when it was going up, so it didn't go to the same high levels. And it's pulled back as well, but it just doesn't have the same downside risk. So although I think the Canadian market is kind of boring and doesn't provide a lot of opportunity right now, it also doesn't have the same level of risk as the U.S. market has. TSX Venture market, heavily weighted in commodities. It broke its steepest downward trend, so I've drawn a line across those tops. That's the pessimism, and we broke that a couple of weeks ago. We're still far below this longer-term downward trend line, but that still gives some pretty decent upside. Now, does that mean you should go out and buy this market? Well, let's remember horizontal resistance. If I drew a little line across this 560 mark, that would be the current ceiling price on the TSX Venture, and we need to see that broken. What that would mean is that we had broken the downward trend, step one. We had built a rising bottom, step two. And then if we can break up and through resistance from a rising bottom, that would be an indication that this market is going to try to cruise back up toward that longer term downward trend line. So this market's showing some very early signs of bottoming. It has a lot of work to do. I wouldn't say rush out and buy these stocks by any means, but certainly you can now at least keep your eyes on them where 3 weeks ago I was saying stay clear of this stuff altogether. The U.S. Treasury bond market. This is U.S. Treasuries, of course, based on interest rates. You can see it was in a bull market there. That means interest rates were going down. The trend went parabolic. I often say that if a market goes parabolic, it usually runs back to the trend line. It fell back to the trend line within a few weeks and then rallied again but made a falling top. Then it broke that upward trend line. So now we've got falling prices for U.S. bonds, which means rising interest rates. Now it's a bit of a wishy-washy chart because here it looked like rates were going up, but then we broke this downward trend line. We broke this pessimism. The seller control was broken. And so that put us back in more of the camp that bond prices were going up, interest rates were going down. In the last 3 weeks, that's reversed again. So the market really isn't sure what it wants to do with interest rates and what it wants to do with bond prices, and it's bouncing all over the place. My feeling is next week, in the next couple of weeks, bond prices probably go up a little bit, which means interest rates go down. The market seems to me to be indicating that it doesn't expect the U.S. Federal Reserve to raise interest rates this week. I think it's a very close call. The market really isn't sure, but I would say 60% chance that rates do not go up this week, 40% chance that they do. U.S. dollar is in a flag pattern. So we had a bullish trend here. I could draw a line across these bottoms. That would indicate that the buyers were in control. That was broken in April. And we've since had falling tops, which means prices are falling for the U.S. dollar. The value of the U.S. dollar relative to other global currencies is falling. But it's not falling that quickly. And this is what's called a flag. It's often just a pause in a long-term upward trend. So if we can break up through the red line, break the control of the sellers that has existed since, I think, March, then we should resume the long-term upward trend in the U.S. dollar. For now, and again with that uncertainty around interest rates, I think the market just doesn't know what it wants to do with the U.S. dollar, so it's sort of drifting around without a lot of direction. Something important to keep an eye on, because if it starts to break up and through this, that's going to be harmful for commodity prices and really indicate that the U.S. is doing okay while the rest of the world is really suffering. I think if the global economy starts to get better, then you're not going to see this break out of that flag pattern. All right, here's gold, downward sloping channel. Been like that for a long time. Traders can take advantage of these little 2-3 week pops that gold makes once in a while when there's some uncertainty in the world, but generally I want you to avoid gold because it is in that downward sloping channel. It needs to break this cycle of falling tops because falling tops are a sign of pessimism, of seller control. Oil broke its downward trend line. Again, this is the most steep of downward trend lines. If I showed you a 3-year weekly chart, you would see this is still well into a downward trend. But in the shorter term, it did break this right here. We talked about that being a sign of a potential bottom in the short term. It's now making this little flag pattern here. It needs to break up through the red line in the next week or two to show us that oil, in fact, does want to bottom. right now testing that support. If it breaks down through 8, we could retest those lows at 7. Again, those values for the oil ETF, OIL, which basically resembles the price of oil. So I would put oil at a neutral rating in the short term right now. It's trying to bottom, but it's still long term full of pessimism as the sellers remain in control. Volatility is still pretty high. It's come off a little bit in the last week and a half. You can see the slow movement down in volatility. That's showing that investors are getting more confident, and that is really documented by the fact that when we looked at that S&P chart in the short term, the line that I had drawn across the tops was converging toward the line that I had drawn across the bottoms. Volatility is compressing, and that means investor confidence is increasing. You probably want to watch this video a couple of times to get all these things sorted out, because although they're simple lines, they get a little bit complex on how they all work together. All right, so my outlook then. U.S. stocks, long-term bearish, short-term neutral. Canadian, neutral, neutral, and I've actually raised my long-term rating to neutral this week simply because I don't know that the Canadian market has as much downside. It's suffered a lot already. Gold, bearish on both time frames. I want you to avoid gold unless you're a very short-term trader. Oil, bearish long-term, neutral, trying to bounce. We could see if it will succeed in that, and you want to watch that closely because there will be a good tradable rally in oil stocks if it is able to break that red line that I had shown in that chart. All right, U.S. markets are trying to base, but may be doomed if they fail to rally to new highs. There is very little opportunity in the Canadian markets, but also less downside risk, and we could see the Canadian markets start to do a little better in the weeks and months ahead. Gold remains in a downward trend while oil tries to base, but has a lot of work to do. Opportunities in playing some of the oversold bounces. I think there's a lot of stocks that have been really beat up with this correction, and we may get a little bit of a bounce back where you can trade them for a couple weeks and make a decent return on those. Focus on the Fed decision this week. That's what the market will be focused on. Well, that has been the Stockscores Market Minutes for, September 14th, 2015. Have a great week in the market and trade well.